Gold and silver had a difficult week, and the reason was not lack of fear in the market. There is plenty of fear. The war in the Middle East, the crisis in the Strait of Hormuz, higher oil prices, and uncertainty around US-Iran talks are still pushing investors towards safer assets. But this week, another force pulled in the opposite direction: interest rates. Spot gold fell on Friday to around $4,461 an ounce and was on track for a weekly loss of about 1.6%. Silver also weakened, dropping nearly 1.8% on the day as traders reassessed how the Federal Reserve may respond to the oil-driven inflation. That is the tension shaping precious metals right now. Normally, geopolitical instability supports gold, but when the same conflict pushes oil prices higher, also raises inflation fears, and inflation stays high, investors begin to price in the possibility that the Fed may keep rates elevated for longer or even tighten further. That hurts gold and silver because they do not pay interest. So the market is caught between two impulses. One side is buying metals for safety, the other is selling because higher rates make non-yielding assets less attractive. This is why the Middle East crisis has not produced a straight line rally in bullion. The Strait of Hormuz remains central to the story. With shipping still disrupted and oil trading around elevated levels, markets are treating the crisis as a both geopolitical shock and an inflation shock. If the conflict widens, gold and silver could quickly regain safe haven momentum. But if oil remains high enough to make central banks more hawkish, the upside becomes harder to sustain. There is also a regional angle. In India and parts of Asia, physical demands have softened because prices remain volatile and historically high. Chinese gold premiums also fell this week, suggesting buyers are becoming more cautious at current levels. For silver, the picture is slightly different. Silver often moves with gold during periods of fear, but it also has a stronger industrial component. That means weaker manufacturing data, slowing growth, or pressure on electronics and solar demand can weigh on silver more heavily than gold. So while both metals are being shaped by geopolitics, silver is more exposed to the economic slowdown side of the story. The broader signal from precious metal is not that investors are calm, it is that they are conflicted. They want protection from war risk, inflation, and currency uncertainty. But they are also watching the Fed, the dollar, and US economic data. Next week, that makes US jobs data specifically important. The non-farm payrolls report, ADP employment figures, jobless claims, and ISM data will all help shape expectations for interest rates. Weak data could revive recession fears and support gold. Strong data could reinforce the case for higher for longer rates and keep pressure on metals. The key geopolitical trigger remains Hormuz. Any clear sign that shipping is resuming could reduce safe haven demand and trigger profit taking. But new strikes, a collapse in US-Iran talks, or a wider regional conflict would push investors back into the gold and silver very quickly. So the takeaway this week is this: gold and silver are not ignoring the crisis. They are pricing two risks at once. War risk is keeping a floor under the market. Rate risk is limiting the rally. Until one of those forces clearly wins, precious metals are likely to remain volatile.